Global Finance, Topic 2, Foreign Exchange Rate Systems, Exchange Rate Determinants, and the Effects of Changes in the Exchange Rate or Revaluation. Copyright Lou Gaddis. In this topic, we're going to talk about the advantages and disadvantages of differing exchange rate systems, the effects of appreciation and depreciation, how exchange rates are determined within fixed rate, floating, and managed rate systems, and how to forecast exchange rates using interest rates and inflation. And lastly, the causes and effects of major currency crises. So the first question you might ask is I'm not a financial manager, so why should I care about exchange rates? Well, it turns out that exchange rates are incredibly important to many fields in finance, business, and other areas. For example, in supply chain, an exchange rate changes, then it immediately changes the cost of foreign imports, outsourced labor, and other international costs. Marketing, when the exchange rate against a trading partner changes, the relative prices of your goods relative to your competitor's goods changes. In accounting, when an exchange rate changes, it may force you to revalue assets and liabilities denominated in that currency, which could then trigger an earnings change. In economics, if an exchange rate is free floating, then an exchange rate in some way reflects the economic health of that nation by incorporating all factors including growth, inflation, demand for exports, competitiveness, budget deficits, and general investment attractiveness. For financial investors, when the dollar changes against major currencies, the value of your foreign investments will change. In political science, a study of exchange rates will allow us to see some of the incentives of, say, the Eurozone in China and how they use exchange rates to achieve political objectives. And as a tourist, obviously, exchange rate has a huge impact on your budget. So let's talk about how exchange rates are determined. First of all, let's just talk basics. What is an exchange rate? Exchange rate is the price of one currency in terms of another. So, for example, many currencies are quoted directly in terms of dollars. So we'll call this a direct exchange rate. So whenever you see the dollar price of a euro, say $1.05 per euro, that is a direct currency exchange rate. A dollar price of a pound, that is a direct exchange rate. Now that's the normal way we usually see prices for an American, right? When you go to a store, you might see bread is selling for $2 per loaf of bread. So a direct quoted exchange rate is a normal way that we express the price of any commodity. So this is kind of the natural way we would think about exchange rates. However, many exchange rates are quoted in indirect terms. So for example, if bread at your supermarket is selling for $2 per loaf of bread, you could also get a bread per dollar price. You can say that one loaf of bread is selling for $2. Or you can say I can get a half a loaf of bread for $1. So the bread per dollar exchange rate would be 1/2 a loaf of bread per dollar. Now that's kind of a weird way of thinking about the price of bread, but many currencies like the Brazilian real, the Chilean peso, the Peruvian nueve sol, Japanese yen, and the Chinese yuan are all quoted in these terms. How much of the price of another commodity, say real or yuan, does it cost to buy $1? So a direct quote is the dollar price to buy 1 unit of a commodity, say a euro. An indirect quote is the foreign currency's price to buy $1 US. And again, currencies are important because they affect the prices and demand for exports. And when we talk about as a currency crisis, as a sudden change to an exchange rate, usually a collapse, and can have big effects. So we'll talk about a currency crisis. So again, a currency crisis is a rapid, disruptive exchange rate change, usually a devaluation, usually associated with some kind of geopolitical or economic shock in a developing market. Or, as we're looking at right now, the Russian ruble is going through a rapid disruptive devaluation right now. Now, often, unlike the ruble, however, it's often associated with the failure of a fixed rate system, in which a government, which had unnaturally held an exchange rate up, finally gives up and it collapses. But in the case of the Russian ruble, it's being driven by geopolitical events and the fall in oil prices. So let's look at the effects of a rapid devaluation of a currency. Again, most happening in emerging markets. Now, in the short run, as your currency value falls, it buys less and less foreign currencies, which means you're going to see an immediate spike in the cost of imports. So the Russians now are seeing an immediate spike in the cost of, say, medicines and technology and food that are imported outside of Russia. You also see a rapid reduction in foreign investment as firms start getting nervous with a devaluing currency about the general prospects of the area. And also, you may not want to operate in an area with a devaluing currency because any profits you make in that currency will be worth less and less in your home currency. Also, many developing nations will have loans in foreign currencies. For example, you may have a small African nation that finds it easier to borrow in capital markets in euros. So they now have fixed expenses in euros. Loan expenses. If their home currency devalues, it will cost more and more of their foreign currency to pay off, say, the euro-denominated debt. However, in the long run, a rapid devaluation of a currency is what we think is primarily inflationary. So what we would expect to see in Russia with the rapid devaluation of their currency is a spike in inflation as all those imported goods whose increased prices start working their way through the supply chain and making all goods more expensive. However, the rapidly devaluing currency will also make your exports a little more attractive to others, a little cheaper to the outside world. And this is called the self-correcting mechanism of a free-floating exchange rate. If there is a disruptive event in your country, your currency is going to devalue, and you're going to have some short-run effects. In the long run, you're going to get inflation, but also your exports are going to get cheaper, which is going to help bring your economy back into line. That's one of the main benefits of a free-floating exchange rate. So let's talk about the different types of exchange rates or exchange rate systems. The major currencies are on a free-floating system like the dollar. So the dollar goes up and down with the supply of dollars and the demand for dollars. There's no government intervention. There's managed float. That's a case where a currency primarily floats. However, the government will step in when they think it's excessively volatile or some level too high or too low. Fixed rate systems or even currency zones are areas in which a group decides to fix their exchange rates to each other, or maybe in the extreme, adopt a common currency. So they're all effectively fixed as long as they stay in the zone. And then there's dollarization or euroization. That's a system where you actually use another country's currency as your currency. So, for example, the Bahamas may use the US dollar as their official currency. So why would you choose one or another? Well, a free float exchange rate, the primary benefit is it requires no government effort. The government's not trying to manipulate exchange rates, which causes them to do all kinds of things with money supply and others. They can focus on their primary economic goals. Also, a free-floating exchange rate gives you that economic stability. The idea that if your currency falls because you're failing for some reason, that'll make your exports cheaper and then things will get better. The disadvantage of a free-floating exchange rate, there could be excessive volatility. It makes it harder for corporations and businesses to plan. Now, a managed float, you might say, well, that could be the best of both worlds. You allow currencies to float, and then you just step in and reduce volatility or guide it away from a level you're uncomfortable with. The problem with that is you not exactly know when to step in or how to step in or how much you have to change different levers to get the exchange rate back. A fixed rate system or a zone, like the Eurozone, The main benefit is there's actually no volatility. The exchange rate is absolutely fixed. Right? Italy and Germany have the same exchange rate. They're effectively fixed because they use the same currency. There's no exchange rate risk between Italy and Germany and France. And maybe it encourages financial discipline, as we'll talk about later. One way to try to maintain those balances is try to have common growth and inflation targets, inflation levels. But the main risk of a fixed rate system or a currency zone is the potential for a huge crisis, which may be looming right now with the potential of the Greece defaulting and exiting the euro. Because having a fixed exchange rate when the economies are very different causes mismatches. So, for example, let's talk about the euro for a minute. One reason that the euro is currently having trouble is generally Germany's been doing very well up till, say, a couple months ago, and the euro is relatively strong, while Greece was failing. High inflation, high wage costs and wage inflation, and huge budget deficits. Now, normally, if you had a country with those types of issues, your currency would devalue and your exports would then get cheaper. But in effect, Greece was failing while the currency was strong, which was making things twice as bad. And dollarization. Advantages, you usually pick a very stable currency, namely usually the euro or the dollar, which have low inflation, low risk. The disadvantage of euroization or dollarization is you don't get to print money and get services for it. We call that seigniorage. Right? If I owned a country, one of my favorite things to do would be to print pieces of paper with my face on it, and people will give me goods for it. So when countries give up that right, they lose a lot of money. But they gain stability. Our current system is the major currencies are floating. The dollar, the euro, the pound, the yen, the CAD, Canadian dollar, Australian dollar. And there's some managed floats. The yuan. The Brazilian real kind of goes back and forth between floating and managed float. And even the Japanese yen kind of goes back and forth between a managed float and a free float. You have many dollarized and euroized countries. You have a lot of target zones like the Eastern Caribbean currency unit and the franc zone, which I believe is in Africa. And then you have common currency zones like the euro. And you also have a number of currencies like the Danish krone and the Hong Kong dollar that have their own currencies, but they just choose to peg them to another currency. The Hong Kong is pegged to the US dollar, and the kroner is pegged to the euro. Here's just a picture of some of the dollarized or euroized countries. So US dollar users, besides the US, are little parts of Central South America, Africa. You also have currencies that are pegged to the dollar, Saudis, it's like Venezuela. You have euro users, which is the eurozone, which includes Finland. And you have currencies that are pegged to the euro, large parts of Northern Africa. And then here are your major other currencies, the Australian dollar, the Indian rupee, the Chinese yuan, and the Japanese yen off here. This is just a blow up of the Eurozone. So you know that Britain never joined the Eurozone. So we're talking about Ireland and this part of Europe are using the euro, including Finland, Estonia, Latvia, Lithuania are planning to go into the Eurozone. And then you have major floating currencies, again, like the pound, Swedish krona, Polish zloty, Czech, Romania, Hungary, Croatia, floating. And they have currencies that are currently pegged to the euro, and they're usually the currencies that are trying to get into the Eurozone. Latvia, Lithuania, Bulgaria, except for Denmark. Denmark has no interest in being in the Eurozone, but they are pegged because that's a major trading partner. And then here you have Greece. The question is, will they exit the euro? Now the Brazilian real, just for example, real meaning royal or real in Portuguese, plural reais. It's divided into 100 centavos, and it's generally floating or a managed float. Here's their coinage. And as of January 2015, 2.66 real bought $1. But as of late March, the dollar has actually appreciated against many currencies. This is the real price of $1, and it's now trading it at 3.22 real per dollar, which means it costs about 30 cents or 31 cents to buy a real. So if you see something trading for one or selling for 1 real, that's about 30 cents. If you see something trading for about 3 reais, that would be about $1. So this graph is now out of date. It is blown through there and is now trading up at 3.22. So let's talk about what determines an exchange rate in a floating free market system. We'll talk about supply, and then I'm going to talk about demand for a while. At any given moment in time, there's a fixed supply of currency in circulation. The government issues currency as it needs to pay its bills. So as governments print more and more money, that puts inflation pressure on prices and also leads to an increase in supply of the currency, which would devalue a currency. On the demand side, it's important to note that currencies provide no inherent utility. In other words, you don't buy a currency to consume it or as an investment, right? It provides no interest. So the only reason you want a currency is for what it can buy. So a currency's value, if supply is fixed at a given point in time, is really the demand for goods and financial assets that that currency can buy. So let's talk about that. So why would I want a particular currency? Because I want goods and services from that country. I want financial assets from that country. Or we can always talk a little bit about the government can get involved and intervene in exchange rate markets. So let's talk about demand for goods. If there's a demand for a particular good in a country, say I want a new BMW, I'm an American, I'm going to create demand for euros. Now when I go to my local dealership and buy a BMW and pay say $40,000 or $50,000, right, I don't really see the demand for euros. But that dealer is going to take those euros, take that $50,000 and has to send it back to Germany. So what they're going to do is they're going to go to New York, sell those dollars, or go to a bank at least, sell those dollars that you just gave them and buy euros. So your demand for European goods, cars, wine, fashion, causes demand for the currency, which would cause, say, the euro to appreciate. So if a country has very competitive, desirable products, it's going to increase the value of their currency. One disastrous example of this is the Dutch disease. And it refers to a potentially devastating effect of an increased demand for a country's goods and currency. In the 1960s, the Netherlands found natural gas, just like we've been discovering natural gas in the U.S. recently and shale and fracking. That caused an increase in demand of the tiny country's currency, the Dutch guilder. That increased price of the guilder due to the increased demand for natural gas caused a lot of their industry to become not competitive anymore as their prices went up relative to the rest of the Europe, and they went out of business. A couple decades later, that natural gas was relatively depleted, and now the country is now unable to export as much natural gas, and a lot of their historical legacy industries were failed, and this caused a huge problem for the Dutch economy in the 90s and 80s. So this is related to a general idea of something called a commodity currency. A commodity currency is a currency of a country that has a large share of their exports in a particular currency. For example, the Chilean peso. Chile's main export is copper. So if there's increased demand for copper or increase in price of copper, people are going to need more Chilean pesos, so the currency might actually trade with copper prices. And the same with oil for, say, Canada. Or metals, and especially precious metals for South Africa, and oil prices for Norway. So a lot of countries are called commodity currencies because the currencies will generally trade with their leading currency. All right, the idea that if oil prices are down and you're an exporter of oil, people need less Canadian dollars to buy your oil. So these currencies generally trade with the commodity itself. The commodity goes up in price, the currency goes up in price. All right, so that's the first thing we'll talk about on demand. The second one, we'll talk about inflation. Inflation is a term for the general rise in price levels. Inflation can happen due to increased money supply, printing of money, excess demand for goods, maybe an overheated economy, or some kind of scarcity or increased production costs, which makes good prices go up. For any reason, if a country is experiencing a high inflation level, that means that their currencies will buy less and less of that country's goods. Therefore, there will be less demand for that currency, and the currency will devalue. So the bottom line is if a currency area has high inflation, their foreign exchange value or currency will go down. So there's an inverse relationship between inflation and foreign exchange. Another reason that people would want a foreign currency is demand for interest rate products. Say bonds. I may desire a German bond because it offers maybe a higher return after inflation. So here's an example for a Brazilian bond. Say, for whatever reason, Americans see that Brazilian bonds are more desirable. Maybe they raised their interest rates and their risk levels look moderate. So why would I get a one-year treasury that gives me 0.5%? I can get a Brazilian real, which is relatively safe, a Brazilian real denominated bond that might give me 2%. That's going to increase, and for me to buy that Brazilian bond, I'll need to first buy REIS first. That's going to create a demand for REIS. So my demand for a bond in Brazil is going to cause a demand for the currency, which is going to cause an appreciation of the real. In other words, an increase in the dollar per real exchange rate. Inversely, a decrease in the real per dollar exchange rate. So an important thing to think about here is investors are really searching for high real interest rates, meaning the interest rate on the bond roughly minus the inflation rate. And there are models to help us forecast exchange rates if you have a forecast of inflation rates. This model is called purchasing power parity, and it goes with the idea that if inflation is relatively high in one country, its currency will fall. The equation for that is the new exchange rate at time t is the old exchange rate times a ratio of 1 plus the inflation levels. Now, if you look at this, this says the exchange rate at time t. Now, I just put a currency H over currency F. You can think of that home over foreign, or just simply currency H over currency F. Equals today's exchange rate times relative inflation levels. So, for example, say the spot price of the euro is $1.30. That's dollar per euro. And inflation in the US is expected to be 10%. That's US. And euro 4%. What this equation tells you is, well, first of all, an approximation is that a currency will fall and rise with a difference in inflation levels. So over the next year, Euro is going to have 6% lower inflation, or US is going to be 6% higher inflation. An approximation of what's going to happen to the currency is if this is the price of the euro, and the euro is going to go up by about 6%, 6% of $1.30 is about 7 cents. I'd expect this to go up to about $1.37. But this is a precise equation for doing that. Now let's talk about this. So currency H over currency F. All that means is let's just call currency H dollars. Let's call currency F euros. And I would just put whatever this currency is generally stated in dollar per euro, so I'll just keep that. So the dollar per euro exchange rate next year is today's dollar per euro exchange rate. And all you have to do is be consistent. If this is euro, this is euro, this is euro. So it's always dollar over euro, dollar over euro, dollar over euro. So I'll just make sure I put dollar inflation over euro inflation. And you see the euro, based on this PPP model, says the euro will appreciate by about 6% to $1.37. Now the theory behind PPP is the exchange rate would have to change so there'd be ensure there's no arbitrage in goods prices. So in other words, if European goods are falling in relative to US goods by 4%, it looks like all European goods are getting cheaper. However, the exchange rate will offset that effect to maintain purchasing power across the two countries. So the 4% cheapness of the euro goods is offset, the 6% cheapness of the European goods is being offset by 6% appreciation of the euro. So goods have not, in fact, gotten cheaper for Americans in Europe if it was caused by inflation. Here's just more practice. Say the spot price of the Brazilian real per dollar. So let's do real per dollar exchange rate. Say it's initially 2.6. Inflation in the dollar is 3%. Inflation in the real is 7%. We can predict the exchange rate. Well, real has 4% higher inflation. US is 4% lower inflation. So I'd expect that the country with the high inflation will devalue and the country with the lower inflation will appreciate. So what's going to happen is the dollar is going to appreciate by about 4%. Now be careful. Remember, this is the real per dollar exchange rate. So this is actually the price of a dollar. The current price of $1 is 2.6 real. That is what's going to go up by about the difference in inflation rates, 4%, which is about 10 cents. So it's going to go to about 270 real. And here's the equation to do that calculation. 2.6 real per dollar. All I need to do is do real over dollar inflation. Gives me a new real per dollar inflation exchange rate. I expect the real to go from 2.6 to 2.7, which is an appreciation of the dollar, depreciation of the real. Suppose the spot price, the Chilean peso per real exchange rate. So this is a strange one, it has no US dollars in it. So Chilean peso over Brazilian real exchange rate is 228 peso per real today. Inflation in Brazil is 7%. Inflation in Chile is 5%. There's a typo here. Let's make that depreciate and make that appreciate. So Brazil has, say, higher inflation by 2%. Their currency is going to devalue. This is the price of a real. So that is going to go down by about 2%. 2% of 228 is about 4 or 5 cents. So the real, the Chilean peso per real is going to get cheaper by about, from 228 to 225, about 5 Chilean pesos. Again, always be consistent. Chilean peso per real, Chilean peso per real, Chile inflation, real inflation. And one last one. Spot price of the Argentine peso is 3.2 Argentine peso per real. So Argentine peso per real. Inflation in Argentina is 25%. Brazil, 7%. The real is going to appreciate by roughly the difference, go from 320 to 374, an appreciation of the real because they have lower inflation. And I'll mention this, I'll give you a couple practice problems at the end. If you assume that changes in inflation levels are what causes differences in interest rate levels of two economies because of arbitrage in bonds, then I could do all of these problems again, except I don't have to use inflation estimates. I can just use interest rates on their bonds. So instead of doing, say, Brazilian real inflation and US inflation, I can talk about the interest rate on real bonds and interest rates on US bonds. So this allows me to use interest rates and not inflation rates, which are readily observable versus trying to get inflation estimates. However, we'll do one caveat to this. I would only use this model for countries with similar risk. So, for example, I'm perfectly comfortable comparing, say, European or German interest rates versus U.S. interest rates, or U.S. versus Japanese, or U.S. versus French, or again, all the major currencies. But I would not use this model for, say, U.S. versus Zimbabwe dollar exchange rate, because I believe that interest rates on the Zimbabwe dollar probably reflect more about chance of default than it does about inflation levels. The search for economic growth is going to cause an appreciation of a currency. So higher growth, higher currency value. As people want to, or foreigners want to buy your stocks, they want to buy your businesses, they want to buy your land because you have economic growth. So a strong U.S. economy relative to the rest of the world will cause an increase in the value of the dollar. And lastly, we have government. Government gets involved either indirectly or directly. Indirectly through fiscal and monetary policy. So through fiscal policy, if a government is running deficits, that's going to cause a currency to devalue. Now in the short run, maybe those deficit spendings increase growth, which may help out the exchange rate, but in the long run, it's going to cause inflation and risk of default and devalue the currency more likely. On monetary policy, anything that affects interest rates or inflation is going to affect the currency. So anything they do with money supply to raise or lower interest rates are going to cause, say, a change in the real exchange rate, which could make the currency go up or down. Or to the extent that they change interest rates directly, that'll make the currency go up or down. When a government has a fixed rate system, the government has to manipulate fiscal policy and monetary policy to maintain the exchange rate. So that's another way in which governments get involved directly. So let's look at a couple examples that were actually one we're living through again. 1998, the Russian ruble massively devalued after the Russian defaulted on their sovereign debt, which is also caused by a decrease in oil prices. So that's an example of a currency that was defaulting due to, one, its reliance on a commodity, and two, the government was running huge budget deficits. Another example is the Greek crisis over the last 5 or 10 years at this point. And that's the example of a government running high budget deficits, largely due to anemic growth and bad policy and an inability to collect taxes. That has put pressure on the Greeks to stay in the Eurozone. And we talk about the pigs. These are the economies in the Eurozone that aren't doing it as well. So Portugal, Italy, Greece, Spain, sometimes Ireland. All right, and then we also have just direct currency intervention. a country can decide that they want to manipulate or stabilize a currency. They can just mandate it. They can just say, this is the exchange rate. All currency must be exchanged at this rate, although you have to be careful because black markets may arise. Countries can just buy and sell foreign reserves to manipulate the currency. So, for example, if the Japanese thought their currency was overvalued, they could start selling their currency and buying dollars to bid up the price of the dollar and bid down the price of their yen. A country could restrict inward or outward foreign investment. So if China was worried about their currency appreciating, they could limit the ability of foreigners to buy yuan and buy foreign investments, therefore decreasing the demand for yuan. And again, through interest rate policy. If they reduce interest rates, they're going to tend to devalue their currency. Which leads to kind of China's policy. China has historically relied on holding of reserves. So the China policy is when they gain dollars into China by exporting goods, the dollars wind up at businesses in China. Now, the normal way, if this were a free-floating currency, would the Chinese business would then sell the dollar and buy yuan in open markets, because that's what they want in China to pay their workers. However, if they allowed this free-floating mechanism to happen, the daily buying of yuan, selling dollars would bid up the price of the yuan and reduce the price of the dollar, which would then make their goods less competitive. So what the Chinese government is doing is when the Chinese gain dollars, the dollars go into the government banks. The government banks then print yuan. And if the exchange rates were, say, 6 yuan per dollar, as the corporation was forced to give the dollars to the banks, 6 yuan would be printed, given to the Chinese exporter. And then the bank, it's not going to stack up dollars, it's going to use that to buy U.S. treasuries and at least get a little bit of interest while they're holding them. And this is the main scheme that China uses to manipulate their exchange rate. Now, in the short run, there are differences in exchange rate versus long run. In the medium to long run, the effects that I've talked about are the most important. Inflation, trade imbalances, budget deficits, real interest rates, growth, competitiveness, desirability for your country's products. But on a daily basis, you see huge changes in exchange rates. And what these are maybe portfolio flows. What that means is maybe there's increased demand to buy U.S. stocks today due to a surging, S&P 500. That could just cause the dollar to jump up today. Or an immediate change in interest rate. So the Fed announces they're going to raise short-term interest rates up 50 basis points. I would expect the dollar to immediately rebound. Speculation, either about portfolio flows or interest rates or geopolitical events, and just policy news. So whether it's a left or right-leaning government is expected to take over, or some kind of geopolitical event happens that causes people to be more fearful about investing in that area, that's what's going to cause exchange rates to change. So here's just some examples. Say today that the government announced that CPI, a measure of inflation, unexpectedly rose in August. What I would expect to happen that day would be the dollar to depreciate against major currencies, as people now just believe the dollar is less desirable. However, if the Fed announced they are raising the Fed funds target rate from 25 basis points to 75 basis points to maintain the current level of inflation. Now, if that was a credible announcement, all that means is inflation is still in check, but interest rates are higher. Therefore, there's going to be more demand of foreigners for U.S. debt. The dollar is going to appreciate. What if the demand and price for natural gas in the U.S. spikes? That's going to cause an appreciation of the dollar as foreigners need dollars to buy our natural gas. Lastly, Greece announces higher than expected budget deficits. That's going to tend to appreciate the dollar. The primary effect is to depreciate the euro as the world decides that euros are riskier. However, that money's got to flow into some currency. The other main currency is the dollar. So hopefully this gave a good overview of what drives exchange rates, the different systems, and the effects.